Can
Okay. Personal work. Okay. For today's class, probably I can only cover for 1 hour. Then after that, the other 1 hour, can we find another day to replace? For example, when can we replace it? Is it okay if we want if we make class? Are you okay if we make class on Sunday? Sunday night?
is this for tutorial?
It's not tutorial for lecture because tutorial will be done by Miss Chia. Because I have a meeting later, so I need to do something preparation. So I can't have the class until yeah this Sunday. Is it okay? Just one time only. After that, we don't do that class anymore. We don't do on Sunday.
If
And after
Saturday,
that on Saturday I
if
have errands to do.
oh,
Night, you mean night time? Yeah, I have errands to do on Saturday night and Sunday. I think it will be available. You're not available. Huh? Probably 8 to 9 only.
is it morning?
No, night time.
Oh, okay.
Is that okay? So we use this same link, 8 to 9. Calvin? Right. So today we're gonna do our class 1:30 to 2:30 only. Okay. Then after that, on Sunday we continue on Sunday. So from 8 to 9. Okay. Okay. So what we have covered the previous class, Clara, you were not, but did you go through the recorded video? Clara?
Yes.
Okay, good. So we have, we have two equation that we have learned. One is accounting equation, asset equal to equity plus liability. And then the other one is profit determination equation, which is profit equal to revenue less expenses. So from that equation, it tells us there are 5 categories for all the transaction, for all the business transaction, we can classify them into 5 categories. That is asset, equity, liability, revenue, and expenses. Okay. So the definition, the keyword, how do we identify or how do we classify into this 5 category? So for asset, we look at whether the item is owned by the business. Owned by the business, then it is known as an asset. Owned by the business and used by the business. Yeah. And then equity and liability, these are the provider. Yeah, the provider of the resources. The resources is the asset, isn't it? And then meaning the provider, the business is owing to the owner for equity, and the business are owing to the third party, that is known as liability. So meaning for equity and liability, we'll look at the keyword owing. Yeah. So owing to the owner, owing to the outsider, liability.
Sir, need to record.
Yes. Oh, okay. Okay, that's what I'm saying. So there are 5 categories altogether. So for asset, we look at the keyword own. Yeah. And then these are the resources owned by the company, by the business. And then who are the provider of the resources? The other side of the accounting equation, that is, if it's from the owner, known as equity. If it's from the outsider, then this is known as liability. Okay, so that is equation. So liability, we look at owing. If it's from outsider, so liability. If it's from the owner, that is equity. Now we have to maintain the equality. Asset must always equal to equity plus liability. Right? So the other equation is profit equal to revenue less expenses. So meaning revenue and expenses. In order to run the business, okay, the business need to incur or consume expenses. So expenses is about spending. And as a result of the spending, the business will earn the income. So that is revenue, isn't it? Income is revenue. So at the end of the accounting period, revenue, we compare with the expenses. So if revenue more than expenses, that will be a profit. If revenue less than expenses, that will be losses. Now, since this is this profit or losses belong to the owner, it will be recorded into the equity, right? So if it's profit, increasing the equity. If it's a loss, reducing the equity, right? So we need to record. In accounting, it's about recording. So how do we record? A system, double entry system has been created, and the guideline is, in order to ease the recording, so we have to classify them as a debit item and credit item. So we look at the right-hand side and the left-hand side. The left-hand side of the accounting equation is asset, isn't it? On the right-hand side, equity and liability. So if we combine all the 5, so asset and expenses we can look into on the left. Yeah. And then equity, liability, and revenue, can group them into the right. So left is a debit item, right is a credit item. Now, let's go through the meaning of debit item and credit item. So debit item meaning whenever we have the effect of the transaction increasing a debit item, we have to record on the debit side. Whereas if you for credit item, any transaction increasing the credit item, it will be recorded on the credit side. So by observing this credit item and debit item, you will always ensure your accounting equation it will be equal. Yeah. So that is why if we have gone through the accounting cycle, we have to do the trial balance. So that trial balance is like a tool for us to check whether have we observed the correct double entry. Because in the trial balance, we are listing the total debit and total credit. So it must be the same. If it's not the same, then we have to check. Yeah, we have to check them whether any possibility that we did not observe the double entry. Okay, so we have gone through a few illustration. So the first thing, we need to identify or classify them as all the five category just now we learned. So if it's asset, equity, liability. So every transaction, they must affect two items. Okay, so meaning we must have one transaction, we must have one debit, one credit. Okay, then the next thing is we need to know who are the users for accounting information. I think I have asked you to read on this, isn't it? So users of accounting system, accounting information, we can divide into two categories. One is internal user and the other one is external user. Internal user, we are talking about the user inside the business. So who are the users? Yeah, inside the business. One of them is owners, shareholders, finance, corporate finance, and investment. Meaning owners or the shareholder. Owners is we are referring with the sole trader. Shareholders, we are talking about the companies. Okay, the companies. So why they need this accounting information? Because they need to measure the performance of the company. So in terms of profit or loss. Okay, and then also they want to look at the financial position. Just now we are talking about financial performance. Now financial position, and then they need to see stability of the business and the growth of the business. Whether the business is growing from one year to another year. Okay, that is the most important thing. You need to be able to describe who are they and then why they need the accounting information. Now, the next one is the management. So management, okay, they need the accounting information for them to, they need this management accounting information. Okay, because this management accounting information, they can use it for planning, organizing, controlling, coordinating, analyzing, and appraising business activity. Planning meaning they can use the accounting information, the data that they have from the financial statement in order to plan what are they going to do the next following year. Okay, and then they can use the information to organize better. Yeah, and then they want to use that controlling the operation of the business. How they would control, because uh, normally a company they have budget every year. So controlling means they compare the budget with the actual and see whether are they performing according to the budget, according to what they have planned. If it's not according to what they have planned, they will identify what is the problem, what is the reason why they are not achieving according to what is being planned, and then take the necessary action. So that is controlling. And then coordinating. So because for every company, they must have the objective. Yeah, the objective is to maximize profit. So they will focus whatever they do. Okay, they will coordinate all the activities of the business towards the same objective, towards the objective, the main objective, maximizing the profit. Okay, and then analyzing. Okay, in order for them take a course of action. So they have to analyze. Yeah. So how they do analysis, they need all this accounting information. And then appraising business activity, meaning evaluating the business activity, whether are they operating effectively, right? So that's what the management need, why they need the accounting information. And the next internal user will be employee, staff that working with the company. So they are concerned about the salary, about the benefit, about the career growth, about their secured employment, career development. Do they have a bonus? Do they have the increment? Okay. So does their work stable? I mean, the company, are they going to receive the salary, especially during the pandemic right now? A lot of businesses closes. So employee are very interested on the financial performance. So all this financial performance of the company, they can get it from the financial statement. Okay. And then the next one is external user. External user, we are talking about outside from the business. So such as the supplier who are supplying the material to the business. Some of them are supplying the business on credit term. So they need to look at their financial statement. They need all the accounting information for them to measure the financial stability of the business. Okay. Or otherwise, they would not release or they would not give any credit facilities to the company. So suppliers, meaning who is supplying the goods to the business on credit. Yeah. So why they need the financial information? They want to measure the financial stability or the cash flow position of the business. Finance provider. Who is this finance provider? Finance provider meaning these are referring to all the commercial banks that is providing loan to the company. Okay, the company need cash, need to to inject the money into the business so that they can run the business effectively with strong working capital. So the only option they have, probably they have to get a loan from the bank, commercial bank. So the commercial bank is known as finance provider. So this finance provider, before they can release the loan, before they can approve the loan, they need to evaluate the financial stability, just like the supplier just now, whether the company would be able to repay back not only the principal amount, but also including the interest they have charged for the loan. Yeah. Now, the next external is government. Okay, government, we are referring with Lembaga Hasil Dalam Negeri, or in English, we call it Inland Revenue Board. So they are interested in the financial information of a company because they need to determine how much the tax payable by the company. Okay. So normally the company, okay, if it's company, the company will be charged based on company's tax. But if it's sole trader, so there will be tax based on the scale rate. Okay, so they're concerned about collection of the tax payable from the entity, from the business entity. And the other one is investor. Investor, we are talking about the future or potential investor, meaning we are referring to shareholders that willing to part the money to invest in the share of the capital, in the share of the company, yeah? The share capital of the company, to buy the share capital. So they need the information in order for them to evaluate the future prospect of the business in terms of the profitability, the stability, cash flow, future plan, and contract. Okay. Now, what about customer? Customer, we are talking about the buyer, buying the trading item, buying the item from the business. So for the customer, they need this accounting information because they want to evaluate whether they will have a long-term supply of good to ensure the supply is secure. Because normally the customer also doing their business. So most probably the business are providing raw material to that particular customer. So without the raw material, they cannot process and produce the finished good. So it's very important for them to look at the stability of the business also. So to ensure they will have long-term supply of the raw material from that particular company. And the last one is public. Public, we are talking about us, yeah, all of us. So, which is the local community. So, for them, they are concerned with the environment, yeah, environment, and also the concern with the job opportunity. Okay, because if you have a business or if you have a factory around your area, this factory is providing job opportunity to the surrounding public, yeah, the surrounding community. But it also affecting the environment if they are factory, isn't it? Whether are they polluting the air. So they are interested in the financial information, okay, in order for them to evaluate whether their operation is actually affecting the environment and also whether their operation will provide a job opportunity and also community responsibility, yeah, fair trade. So that is why the public interested in this accounting information of that particular businesses. Now, any question on the users? So normally it will come out in the theory part. They will ask you to list down 2 or 3 users of the accounting, external users, or 1 internal and 2 external. So meaning both of these users you expected to be able to explain.
So in the test, they will ask this question.
Okay.
So do they ask this question in the test and exam?
Yeah, there is a possibility.
Is it
Oh.
is it
Because
just
now
theory?
accounting, even though it's a, come again? Yeah,
Or is
theory,
it just theory only?
theory part.
The accounting.
No, not all theory, but it's a mix. So they have like if it's one question, 25 marks. So 17 marks will be calculation, and then the rest of it, the remaining marks will be the theory part. Is it okay if everyone of us put on the camera so that now we see each other like communicating?
Sorry,
I
I
I
eating.
can see you. You can, huh? Come again?
Eating my lunch.
Oh, you're eating your lunch. Never mind. You can eat your lunch while listening. Okay. The other one is about the organization and mode of ownership that we have in Malaysia. Okay. So mode of ownership and types of organization. So types of organization that we have in Malaysia, we have trading. Okay, we have wholesaler, manufacturing, and service industry. Trading meaning we buy, the business is buying good, and after that they sell it at the higher price in order to get uh, the profit. Yeah. So what are the example that we have doing the trading? We have the supermarket like Chua Kaseng, we have Survey. Okay, so they buy goods. They don't buy good actually. They're providing a place, for people to display the goods. And then when people buy, this is like consignment basis. Yeah, if people buy, then the chua kaseng is regarded as buying item from that particular vendor. Okay, this is still under trading now, right? So no manufacturing involved. They just buy the good in bulk quantity in order to get a better discount, and then after that they sell it to the final customer at the higher price. Okay, wholesaler meaning this one is another they buy good in bulk, large quantity from manufacturers, okay, importer, and resell to retailers in smaller quantity. This one is different. Wholesaler means they have the facility where they can keep in large volume of goods. So they have gudang, warehouse. So meaning not every supermarket has the warehouse. So only the wholesaler. So that's why they have more discount when they buy from the supplier. When they buy from the supplier, okay, so they keep all the goods into the warehouse. Then this wholesaler, they don't sell to the individual customer like us, but they only sell to the supermarket. Yeah, retailers. They only sell to the retailers in a smaller quantity. Now, next one is manufacturing. This is the, the one that doing the process lah. They process the raw material into a finished good. Production process that convert raw material component into finished good. So this one, in this industry, involve manufacturing account, manufacturing costing, process costing, good production costs. So different type. And then the last one is service industry. Service industry meaning this business, they are not selling any goods, but they're only providing services such as accounting firm. Accounting firm, they only provide accounting services, no product. Yeah, like lawyers firm, they're only providing services like what do you call it? Law advice, yeah, taxation advice. So those kind of service now. And then we have tourism also no product like hotels. So they only provide room service. Yeah. Okay. So accounting firm, law firm, no inventory, insurance company, bank, hairdresser, consultancy. So whenever you are asked to explain in the theory part, so make sure you'll be able to explain what is it, and then you need to provide the example, which industry, yeah. Now, modes of business ownership. So this one, we have a few options that is sole proprietorship, and then partnership and company. So why we have so many? Okay, because if it's because of the needs of the business to expand. So because if it's sole proprietorship, meaning this owned by one person, by one individual. So one individual meaning one capital. So restricted, isn't it? If the business need to be expanded, so they will have restriction on the capital. So that is why we have partnership. But the problem is partnership. So maximum is not more than 20 partners. Okay, business is owned by at least 2%, but less than 20 individual.
Why not more than 20?
That's why that is the restriction. If you want more than 20, you want more capital, then you can go. The option is to go for company.
Is it like going to the stock market, like sell the stock like that?
That one is another thing. That one is whether you want to be listed in Kuala Lumpur Stock Exchange or not, because there are few strict requirement by Bursa Saham Kuala Lumpur. Okay, like you must have a paid up share capital above 2.5 million, and you must have how many employees, how many turnover in a year. So that is a requirement. Then you can be listed in the Kuala Lumpur Stock Exchange. Then you can trade in the market, meaning public can buy your share. Okay, so let's go through one by one. So sole proprietorship by one individual. Okay, normally this is suitable for small businesses. Okay, or basically the business are run by one individual. Okay, and he will be helped or assisted by family members, and the profit all belongs to the owner, and he can do. That's why you have a drawing account in the sole proprietorship, because that business is owned by one person. Okay, and how the sole proprietorship will be taxed? It is based on individual tax. So using scale rate, so it's much more lower, right? So the disadvantage is you have unlimited liability. So what is the meaning unlimited liability? Unlimited liability means if the business failed, yeah, so unable to make payment of all the liability, so the payables can go after the personal asset, meaning it's not only the business asset, but also the personal asset of the business of the individual, the owner. Okay, so if the owner cannot pay, and then when the payables cannot get anything from the business anymore, they can go after the asset of the owner, the personal asset. Okay, to repay back for all the liability. Now, partnership, at least 2 individual, but less than 20 individual. Okay, we can have more than 20 partners, but this is only for professional partnership. Like if you have accounting firm, okay, they can have many members. Yeah, or even the lawyers, they can have many members, more than 20 partners, only for professional partnership. Okay, so partnership meaning they are jointly managed by the partners. Okay, so and if anything happen, and they will jointly settle all the debts or the loan. So they are they're having the same features like sole trader. Yeah, like if the payables, the partnership unable to make payment. Okay, so the payables can, yeah.
Sorry, sir. Do they usually get have a leader or something?
Yeah.
When there's partnership
There should be one key partners lah.
To represent
the
them.
key partners, yeah.
The key partners.
Yeah, they call it key partners. So meaning he is the one that who is normally you have active and inactive partners. So
do they also decide if which one, do they evenly share, or there's some people own, some people are like more important than the others?
Normally they will have a partnership agreement. So before they start operating, they will have partnership agreement stating how many percentage of partnership they have. Let's say they have 3 partners, so they will decide 60% will be for A, 40% will be for B, and C will be the remaining. Let's say 60%, 20%, 20%. So they have they already stated in the first partnership agreement. Otherwise, whenever they have disagreement on certain things, So there will be a lot of problem. So that is why they have to do the partnership agreement before operating.
Okay.
Okay, so they jointly run. So how they run also sometimes it will be stated in the partnership agreement. And if, for instance, just now 60%, 20%, 20%, if three partners, like what I've said just now, if, for instance, they have a debts, yeah, loan in case the partnership fails. So these debts also they're going to settle according to that partnership agreement. So 60% must be settled by A, 20% settled by B, and the other 20% settled by C. Okay. So if the partnership business fails, so unlimited liability on the partnership. This one, if they don't have a partnership agreement. So meaning if they have owing the liability 1 million, so three of them, so they have to divide it by 3. You understand what I'm saying? So probably about 350,000 each, just to pay for the 1 million debts.
Oh, yeah.
Okay. Now the profit and loss of the partnership are shared by the partners based on what they call it profit sharing ratio. Okay, profit sharing ratio. So partners, again, there will be tax according to individual tax, just like sole proprietorship. Now, if the business need to expand, but then they already exceeded 20 individual, they can make an option to be a company. So company minimum at least 2% up to any number, and it can be either private limited company or public limited company. Okay, so there is no maximum numbers of shareholders. So they don't call it partner, they don't call it capital, but they call it shareholders, those who are having the share in that particular company. So they have two options, whether they want to go for private. So how do you identify private? So we look at the name of the company always ended with Sendirian Berhad. If it's public limited company, it will always end up with Berhad. Okay, so normally the company, the shareholders are not running the business. Instead, it will be run by professionally, managed by directors. Yeah, so the board of directors and management team. So this board of directors and management team are selected by the shareholders. Shareholders are not required to settle the business debts loan if the business fails. The liability on the shareholders are limited to the share capital injected by them. So what does it mean? Meaning it's different from partnership and sole proprietor. They have unlimited liability. So for companies, they have their liability is limited to the share they bought in that company. If they have settled all the share that they bought from the related company, so they are no longer in debts. Yeah, meaning in case the company collapse, yeah, the payables cannot go after the shareholders' personal belongings because they already have settled all the shares. Yeah, and profit of the company normally it will be distributed in terms of dividend. Okay, unlike partnership, they have profit sharing ratio. Even the sole proprietorship, isn't it? But for company, they will be given a dividend. So which is the dividend are declared at the end of the year after they have finalized the profit of the company and the financial position of the company. Then they will decide how much is the dividend. Now, company.
So basically, people prefer being a company instead of partnership.
Come again? Which one is better?
Company.
Well, it's up to, I mean, of course, company is better because they have more resources, okay, more stable, yeah, and meaning the liability are restricted to up to the share that you own in that particular company. But then this is like give and take. You have advantages and disadvantages. But then if you are the shareholders of the company, you cannot run the company because shareholders are not able to participate in the management of the company. They will run by professionals, managers. They call it board of directors and management team. Unlike partnership, unlike sole proprietorship, you're running the business, isn't it? So it depends on the person. So which one is better? I mean, all of this ownership is actually better. I mean, they have their own advantages. They have their own disadvantages.
Is there like a difference between a smaller business and a bigger business? Which one's more common?
Well, like in Malaysia now, the common one is company lah. Because they just buy a share from the company, and then they just wait for the dividend at the end of the year.
Or the guys who buy, do they interfere often with the decision making?
No. Yeah.
So they just buy and then they just take the profit and not without interfering much.
Correct.
Okay.
Mm. Okay, this is the accounting cycle. Yeah. So I did explain this, isn't it? Did I explain this? Yeah, from source of document. So remember, every business transaction must be supported with source document, evidence by source document. Then we have to record this source document into the prime entry. Okay, we have 7 books of prime entry. Like what I've said before, we have sales journal, return inward journal, purchases journal, return outward journal, cash book, petty cash book, general journal, and those are the purchases. I mean the prime entry line. So from the journal, so every transaction they must have one specific prime entry, one journal. So from the journal, then we post into the ledger. Okay, from the ledger, there are 3 ledgers. We have sales ledger, purchases ledger, and general ledger. Sales ledger and purchases ledger. Why we have all these 3 ledgers? Okay, because we do not want to put everything in one book, one ledger. Otherwise, it will very messy. So since sales and purchases are the most trading activities in a business, so they have one different ledger that is only to record sales ledger, only to record individual trade receivables account. And then purchases ledger, they have individual trade payables control, trade payables individual account. Okay, and then general ledger is a ledger containing all the accounts, not only asset, equity, liability, revenue, and expenses, but they also have trade receivable control account and trade payable control account. So we take from the general ledger and we draft the trial balance and draft the financial statement. But like what I've said to you, at the end of the year, we have a few adjustment, which is those, because we want to have accurate information about certain, all the expenses. So some of the expenses, they are not paid, so it's not recorded. So we have to do adjustment to provide what is the actual expenses for that particular period. And some of the expenses also, they have paid in advance. So we have to take out the element, the amount that is related with different accounting period. So that's why we call it adjustment. So after we have done adjustment, then we will have adjusted trial balance, adjusted financial statement. It's like I have explained this before. Then we do closing entry. Then this will repeat again. Okay, repeat again the next following year. Now these are the source document. Okay, the possible source document that we will have in the real transaction. So we have invoice, credit note, debit note, cash bill, payment voucher, official receipt, check counterfoil, and memo. So we need this source document when we do the recording. Yeah? So invoice. Invoice is to inform customer the amount to be paid, amount of discount given, whether cash term or credit term, and interest charges for late payment. Okay. Normally, this invoice, whenever you see invoice, this is indicating a credit transaction. Credit meaning if it's sales invoice, meaning we are making the sales. Okay, we provide the customer with good, but no payment is being received yet. So we use invoice. Okay, and then if purchase invoice, okay, meaning we are going to receive the invoice from the supplier. So meaning we get the goods from the supplier, but we have not made the payment yet. So that is on credit. So normally, if it's on credit, then these are the soft documents that you will receive, invoice. Okay, credit note. So credit note is to deduct an amount overcharged in the invoice and return of good from customer. Okay, what does it mean? Meaning, normally this source document, bear in mind, this one always sent by the seller to the buyer. The seller to the buyer. You understand? Huh? Seller to the buyer. It's never been buyer to the seller. So like us, business, so we can be in the position as a buyer and we can be in a position as a seller. So you have to look at the direction of the document. If receive the invoice, meaning that is purchases invoice. But if we send the invoice, that is indicating sales invoice. Okay, that's how we look at it. Okay, so what about credit note? Credit note also the same thing. The direction is from seller to the buyer. So if we are sending credit note, okay, we are actually advising the customer that we are crediting his account. So remember, if we sell on credit, meaning secara hutang, sell to the customer. Let's say my business, okay, ABC Burhan, I sell to customer A on credit. So customer A will be a trade receivable to ABC, isn't it? So trade receivable, as you know, this is a debit item because it's an asset. Yeah. So if it's an asset, a debit item. So if I make a sales on credit to A, so it will be recorded on the debit side of the trade receivable because increasing the trade receivable. Yeah. So debit trade receivable. So let's say the customer returned the good to us and we agree with the return. So what is the document that we're going to send him? We are sending him credit note. Why credit note? Because we are telling him that we are crediting his account. Remember, crediting a debit item, we are reducing, isn't it? Remember, if it's a debit item, increase is on the debit sign. Did I confuse you? Can you understand what I'm saying?
Yeah.
You understand?
A little bit lah.
Okay. Let me see. Okay. Okay. So what I'm saying, let's say this is trade receivable. Yeah, stable. Okay, let's say this is trade receivable. Remember, trade receivable, I told you, is an asset. So when we make a sales, so this is, let's say, the sales. So I will sell 10,000 on credit to trade receivable. So I do a debit entry because this is a debit item. Yeah. So increase, I record on the debit side. So if I want to reduce, let's say A return the good to the business 1,000. So I would the business, isn't it? So I will put here the particular as sales, and then I put here return inward. Okay, meaning he returned the good. So I put return inward. So what I'm explaining to you, okay, we are telling the customer that we are crediting his account. So that is why we call this as a credit note. Okay, advising the customer that we are crediting his account for the good that he returned. Okay, to deduct an amount overcharged in the invoice. That is another situation. Let's say this one, okay, overcharge. So in order to reduce this overcharge, okay, let's say 1,000 also overcharge. So I will credit his account, reduce his account, isn't it? So in order for me to reduce his account, so I have to send, the business have to send the credit note, the source document. So what is the source document? We call it credit note. So I'm explaining to you why this is called credit note, because we are telling the customer that we are crediting his account, reduce the amount. Okay, so debit note is the opposite. So if you want to add the amount of invoice for any additional charges, like we have transportation charges, interest charges, then we are increasing his account by putting the debit sign. So that's why we call it debit note, right? Okay, can you understand that? Correct? Are you
Yes.
okay?
Correct.
Yeah, understand.
All right. So cash bill. So this one is same as invoice, but this one is on cash term. So when we sell on cash term, so we're gonna give him cash bill. Payment voucher. So payment voucher, this one is to record the payment, either payment made by cash or by check. So it need to be accompanied with this payment voucher. Okay. And then official receipt. Official receipt is when we are collecting the money from the customer. Let's say the customer, okay, on credit, and now after the credit terms expire, so he makes payment. So we must give him the official receipt. That is just to acknowledge the money has been collected. Now, check counterfoil. So this one is the checkbook. The checkbook we have, let's say this is the checkbook, very ugly. So we have the left portion. So this one, the checkbook, we give it to the customer. And this one, left portion, it will be kept. It will be retained. Okay, where inside this check counterfoil, you have details like the date, the name of the customer, the amount, the check number. Okay, for our safekeeping. So to record the amount paid on particular number check, the counterfoil is the portion left after tearing out the particular check. And the last one is memo. Memo is a written message note from the management to inform about decision on certain transaction. Okay, so this is like internal communication, informing a certain instruction to the staff. So we use memo. Okay. Right. So next one. Books of prime entry. So there are 7 books of prime entry. So prime entry meaning this is buku catatan pertama. The first thing that we need to record. It's just like a diary. Okay, because business transaction occurring on daily basis. So on daily basis, we put into the diary. Yeah, the diary, that is the prime entry. So every transaction, they must have specific prime entry. So how do we identify which suitable prime entry? So we look at the transaction. Okay, if it's cash transaction, if it's check transaction, then we record into the cash book as a prime entry. If it's small amount of daily payment, yeah, and then like for example, postage and stamp, stationery, wages for cleaning, minor repair, general miscellaneous expenses, then we put into petty cash book. So very easy to identify. Normally, because we have different cash. So there are 2 types of cash. One is based on the cash book, yeah, and then the other one is petty cash book. So if any payment made through the petty cash book for small payment, then we put into the petty cash book. Okay, that is the meaning. Very easy to identify. And then we have specialized journal, like what I've explained to you. If it's selling trading item, we have 2 parts. One is trading item and non-trading item. Like how to identify, like restaurant, the canteen that we have in the campus. Okay, what is the main trading? The main trading is selling food and drinks, isn't it? So any sales on food and drink, this is what we call trading item. Okay, so that will be recorded as sales. But if they are selling the fridge, okay, the fridge meaning the asset they have for use, isn't it? Now they want to replace it. Okay, so they want to dispose that fridge. So the sale of the fridge is not recorded in the sales because this is non-trading item. Okay, that's how we distinguish. So meaning if the business sell on credit, yeah, the food, the drink in the campus, So they will record it in the sales journal. But if they sell the fridge on credit, they cannot record in the sales journal because this is not trading item. Okay, so the same goes with shop selling car spare part. If they're selling spare part, then recorded in the sales journal if it's on credit. Okay, credit term. Remember this one, eh? Credit terms. Credit terms meaning they're selling secara hutang. Now, what about purchases? Purchases journal. Purchases journal also only for purchases of the trading item on credit. Trading item, like if it's a restaurant, if they buy chicken, they buy rice, yeah, on credit from the supermarket or from the supplier, then they will record into the purchases journal. But if they buy share table, yeah, for the business, they don't record in the purchases journal because this is not trading item. This is item they buy for the purpose of using in the business. Okay. Now, the other one is related with sales. Okay, we call it sales return. Sales return is also known as return inward, like what I've explained to you. These are the goods returned by the customer on credit. Yeah, they buy on credit, and then after that, after a while, then they found out the item is not the quality they are. I mean, not the brand name they require. So they return to the supplier, return to us, or even the quantity that is supplied by us to this customer more than he required, so he returned. So this is what we call sales return. Yeah.
Oh,
Other than
the credit, does it count as money also?
come again, the credit.
The credit also is credit also money?
Credit,
like
credit
the
term. Are you referring to these terms, credit terms?
yeah, like is it like a point system, or is it like they
No.
borrow it and then they like give some money as credit?
Credit means, yeah, they get the goods. We okay, this is sales, huh? Sales on credit. So if we sell on credit, meaning we sell to the customer. Yeah, we sell to the customer, but the customer will not make the payment yet.
Ah,
They get the goods, but later, 30 days later, then he will make payment. Let's say we sell in November, 1st of November. Yeah, on the 1st of November, we sell 10,000 unit, 10,000 ringgit worth of items to A. So we record as sales, credit sales, 10,000. But then the payment, we are not, the business are not receiving yet. We only receive it probably 30th of November. So that is credit sales.
okay.
That is credit terms.
But if they don't pay, what happens?
They don't pay, then we have to follow up until, let's say, 1 year after that. Then we cannot collect. Then after that, he was declared bankrupt. Then another option. I mean, we have to write it off as bad debts. So that one is another thing that we are going to learn.
Okay.
But when we did not, I mean, we haven't write it off, so it will be recorded in the sales account. Yeah, it will be recorded in the sales account and the trade receivable. So in our record, it shows the trade receivable that particular customer still owing to us, the business, until we decided to write it off. Did I answer you, Kelvin?
Yeah.
Okay. All right. So I was explaining about sales return. Return of good that was sold on credit term. So this return is only for those bought in credit terms. So meaning if you have cash term, there is no return. Just like if you buy on cash in the supermarket, normally they don't entertain if you return the good to them. So only those that is bought on credit. Okay, so same goes with purchasers return. Purchasers return meaning the business are returning the goods to the supplier. Okay, why? The reason being probably the good were defective or probably the quantity supplied by the supplier is more than what we requested for. Okay, or probably the the brand that we requested is different from what is supplied, so we return. Okay, so other than we have other name for purchases return. We call it return upward. So how do you memorize? Normally, how I memorize inward and outward, whether it's sales, whether it's purchases, I look at the direction. Inward meaning coming back to the business. Yeah. Outward means going out from the business. So if it's outward, so we are returning to the supplier. So purchases return. Now, those are the 6 prime entry. So any transaction you cannot fit in any of the 6. Yeah, it's not cash, it's not petty cash book, it's not credit sales, it's not credit purchases, it's not return. Yeah, inward is not return outward. Then you must put into the general journal. Okay, all other business transaction not involving cash, check, payment, sales, and purchases of goods. So it will be in general journal. So meaning to say, every transaction you must have prime entry. And we have 3 ledgers. So 3 ledgers, like what I've said to you. We have general ledger and we have subsidiary ledger known as sales ledger and purchases ledger. Okay, general ledger
so-
is the main. Yeah.
Already 2:30.
Oh, just give me a few minutes. Just finish off this
Okay.
chapter. Okay, we have general ledger. General ledger is the main ledger. So containing all the account, complete double entry. So whenever we want to prepare the trial balance, okay, we get the information from the general ledger. Therefore, the trial balance and financial statement are prepared using the general ledger. So we have subsidiary ledger, we have sales ledger and purchases ledger. So sales ledger, this one containing all individual trade receivables account. Individual, meaning if you have a trade receivable name A, B, C, D, so you will have trade receivable A, trade receivable B, trade receivable C inside the sales ledger. Same goes with purchases ledger. This one also individual trade payables account. Now, in the general ledger, we will have trade receivable control account, meaning in the general ledger, the trade receivable control account is not individual, but everything is in total amount. So if you want to refer who is the individual trade receivable, then we look into the sales ledger, not in the general ledger, because in general ledger, everything in total, sales also in total, return inward also in total. Okay, so this is what I've explained to you before. We always prepare a ledger account. Okay, we have a ledger account T format. T format, why we call it T format? Because it looks like alphabet T. Yeah. So on the top we have title of account, and on your left is debit, on your right is credit. Then we have trial balance. Trial balance is a summary of balances of all the account coming from the main ledger, general ledger. So it shows the total of all debit items are equal to total of all credit item in the general ledger. So the trial balance is to check accuracy and completeness of double entry system. So adjustment, okay, the reason being we have adjustment because we want to portray the financial statement showing true and fair view. True and fair view meaning taking into account the actual expenses and the actual revenue. Okay, so that's why we need to do adjustment. So after we do adjustment, so we're gonna have adjusted trial balance and adjusted financial statement. Okay, we have after that the last part of the accounting cycle is a closing entry. So we close off, yeah, we close off the income and expenses, and the asset equity liability we balance off. So we carry forward the asset equity liability to the following accounting year. Okay. And then this accounting cycle will be repeating again the same sequence. Now, these are the basic financial statement. Okay, there are 5 altogether. So the first one in a financial statement for company normally, they call it annual report. They must have first statement profit or loss account. Yeah, statement profit or loss account. You have the samples. Okay, this is showing the performance of the business in terms of profit or loss. And then the second one is statement of financial position. So statement of financial position is showing the position, the financial statement of the company in terms of asset, equity, and liability. And then the other one is statement of cash flow. Statement of cash flow is they want to measure the inflow and outflow of the company. And then statement of changes in equity. Okay, this is a statement showing the how the equity change, yeah, in the statement. Yeah? And then the last one we have notes of financial statement. So this one is a more detailed explanation on the financial statement. Okay, so these are all the samples. Okay, like what I've said to you, why okay, first thing, remember this is statement profit or loss. So statement of profit or loss, this is actually reflecting the profit determination equation. Yeah. So remember, profit determination equation involve revenue and expenses only, isn't it? And revenue and expenses, as what we have learned, they are divided into 2 categories, isn't it? One is cost of goods sold, that is expenses, yeah. And then the other one is operating expenses. Revenue, we have sales and we have other income, isn't it? So what is the purpose? Why we have 2 different types? Okay, because of the presentation purposes. This is the presentation. This is the format that we need to do our financial statement. Yeah, so we using columnar form. So this is particular column first. The second column is sub column in order to do all the relevant adjustment. And then second column, and the last one is the final column. The final column is after we finalize the amount. Okay, so there are 2 objectives in statement profit or loss. That is, they want to calculate this gross profit, and then they want to calculate the net profit. Okay, so gross profit, we compare the first type of revenue against the first type of expenses. Okay, sales revenue, sales we compare with cost of goods sold, isn't it? And then after that, we get the gross profit. Gross profit, then you consider the second type of revenue and the second type of expenses. So that's why gross profit plus with the second type of revenue, then less with the second type of expenses, then we get net profit. So normally, when I was studying this, so what I do, I simplify it so that I can memorize this format. So what I do, okay, I put S as sales less cost of sales, then I get gross profit. Gross profit plus other income, and then less other expenses, then I get net profit. I simplify it so that I can remember. Then I will further expand like cost of sales, how to get cost of sales. So the basic thing is opening inventory plus purchases less closing inventory, isn't it? Cost of sales. So this one, opening inventory plus purchases less closing inventory. But you see, these purchases, they have a few breakdown because there are few expenses related with the purchases, yeah. So which is purchases, yeah, you less with return outward, and then plus, okay, wages plus what was it? Carriage inward. Okay, that's why we use this the first column here, where we do the adjustment on the purchases. So we take into account any related item affecting the purchases. So what is affecting the purchases? First is return outward. Second, wages, upah, yeah, upah, wages. And then carriage inward. So like what I've explained to you before, carriage inward is a transportation cost in order to make the purchases. Okay, then we get gross profit, so plus with other income, less with other expenditure. So normally I would put them into the second column so that I list down all the other expenses. Then after I finalize how much is the other expenses, then we put into the third column. Then we minus. Okay, like here. Okay, the net sales after taking into account the return inward, we have 30,600 less with cost of goods sold 14,350. Then we get gross profit. Gross profit plus with the other income less with the other expenses, then we get net profit. Okay, so net profit belongs to the owner, so it will be recorded here under equity. So opening capital plus net profit, then less drawing, then we have closing capital. So far, are you following? I mean, can
Sir,
you understand?
the depreciation, can we short form?
If possible, do not, don't do short form. What do you mean? The depreciation you put as DPN, like that?
Yeah. Can.
If you have time, don't do that.
Oh, so usually put full sentence lah, full word.
Full sentence. But then if no choice, you can, but this one doesn't guarantee you to get full marks now.
Okay.
But normally I will give marks. I will give marks, but then it has to go to reviewer. So if the reviewer decides not to give marks, then I have to follow. Can you understand what I'm saying? So meaning I don't guarantee to get a good mark for that if you do short form. Okay, so this one is accounting equation. Accounting equation, which is asset equal to equity plus liability. So asset is this one. Yeah, we divide into two: non-current asset and current asset. Equity, this one, and then liability, this one. Liability also we have current liability. First thing, you must have non-current liability. If you have non-current liability is NCL, then followed by current liability.
Are these this thing, the statement will be, is it public to anyone can see like this, or is it only for the,
yeah, it is public.
it's public?
Yeah, so that the investor also can see. Yeah, and then this one is a statement of cash flow. Statement of cash flow. Just now is the statement of profit or loss, but then it doesn't show you the actual cash. So in order to get the actual cash, so this is presented by statement of cash flow. So different way. This is not in the syllabus now. So you have to divide them into operating activity, investing activity, financing activity. So operating activity is referring to the normal operation of the company. Yeah. And then investing activity is like when they buy the non-current asset. And then financing activity is how they increase their share capital, either by equity or by loan. Yeah, financing. And the last one is the statement of changes in equity. So equity is referring to the share, the shareholders' equity. So that consists of ordinary share capital, preference share capital, share premium, revaluation reserve, retained earning. So any movement like the opening balance, and if we have transaction for the particular year, we have to show it in this document. So this is not in the syllabus yet. Yeah. So this is only showing you how it is being done. So you don't have to know how to do it at this level. Okay. So that is conclusion for chapter 1. And I wanted to go through the chapter 2, that is cash book. Cash book. So cash cycles. We have two different prime entry. One is cash book and petty cash book. So I'll see you on Sunday night. Yeah, explaining about this. All right, class.
Okay.
Okay.
So thank you for your attention and for your kind consideration. So I'll see you on Sunday.
Okay, sir.
Okay, thank you, sir.
You may leave the class.